Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Hope you're doing well. The stock market has certainly had an interesting couple of months, and I don't think that changes anytime soon. But I wanted to make a quick video about 10 stocks I've started buying recently in this newly created portfolio that's focused entirely on stock buybacks. And stock buybacks are something that I like a lot. I like them a lot more than dividends because they're not taxable to me. Right now, I don't need money to spend from my investments. I'm still in the accumulation phase of my investing career. So I'd rather, if the company is going to return money to me some way, they do it in a way that's not taxable to me, and a buyback does that. It's a form of shareholder yield, and it's just a way to juice future earnings per share by reducing the share count, and these companies have done a really good job of doing that, and we'll look at that in a second. They're also businesses that I think are pretty good. Some of them may be cyclical in nature, so it doesn't mean that this is going to be an up and to the right story all the time, but it's a story that when the company is moving in the negative direction, it's likely still buying back shares in the long run. As long as the business survives, which I think most of these will, it'll be a benefit to me as an investor. And as always, guys, this is not investment advice. So as we look at these stocks, keep that in mind. Please talk to a financial advisor before making any investment decisions. So let's take a look at these stocks. I'm going to put 250 bucks a week into this portfolio, see how it goes, see how it grows. I'm going to share this journey with you guys through a video every couple of months or so. It's not going to be too common, but if you want any additional information about any of these companies, just leave a comment down below. And as always, make sure to like and subscribe as you watch as well. So let's take a look at these 10 companies that are in here, some weighed more heavily than others. We're starting with Mr. Cooper Group. We've got Crox, which I've done videos on before. Jackson Financial comes up next. Booking Holdings, which isn't an amazing value right now, but still a pretty interesting company. Then we got Toll Brothers, a home builder. Builders First Source, a company that provides materials for home builders. PayPal, which I've done videos on before as well. Owens Corning, MGIC Investment Corporation, and then NMI Holdings Incorporated. Starting at the top, we've got Mr. Cooper Group. This is a mortgage servicer slash mortgage originator. I really like this business because the origination business is kind of boom and bust. When interest rates are high, the originations aren't as amazing. When they drop like they did in 21 and 22, it can really explode and they can generate a ton of free cash flow, which they did in 21 and 22. They use that money to buy back shares, but also to expand their servicing business through some acquisitions. And now their servicing business is a pretty sizable business on its own. So even when rates are high and originations isn't doing that amazing, the servicing business kind of picks up the slack, generates a bunch of free cash flow, and they're consistently buying back shares and growing their EPS. Second is Crocs. They make silly shoes. I've done videos on these guys before. I will link one of those down below, but they are buying back a ton of shares. Just announced a $1 billion share repurchase program against a $6-7 billion market cap. They did make some spotty acquisition in the last 2 years with Heydo. They spent $2 billion on a company that's not worth anywhere close to that. They should have just bought back shares. Big spoiler about why I like stock buybacks, because sometimes you just spend money on stupid stuff where if you just bought back shares and focused on your core business, you would have done just fine, which I think Crocs is doing that on a go-forward basis. Jackson Financial is third. This is a variable annuity business. They just spun off from Prudential maybe 2 or 3 years ago. They are generating a bunch of free cash flow. They do have a dividend, maybe 3.5% yield or so at today's prices, but are also buying back a bunch of shares. After that is Booking Holdings. This is a travel booking company. Again, I think there's some risk with this one if there is boycotts of travel to the United States from various countries, but I think this is still a very good, very well-run company in the long term. It is kind of expensive right now, so I'm not like putting a ton of money into it, but I think I'd like to build a bigger position if there is some opportunity with some price reductions. After that is Toll Brothers. This is a home builder. Again, some of these are cyclical businesses. Home building certainly could be if interest rates stay elevated or even go up. Will new house sales drop? Potentially. The reason I like Toll Brothers in relation to some of the other home builders is they focus more on the luxury side of things. Their houses are in that $1 million on average price versus some of the other home builders like Leonard, DHI, Pulte in that $400,000 to $600,000 range. And those are more prone to economic distress versus these $1 million houses, which are kind of do better in those times. And again, if a recession happens, will a lot of these companies drop like a stone to the ground? For sure. But I think these companies can certainly survive a recession. That's one. But two, can still generate free cash flow during a recession. And three, more importantly, buy back shares at reduced prices, which I would like from a long-term perspective. Builders First Source, another company that is tied to the real estate market, to home builders in general. They provide lumber and other materials to home builders, but I think this is a one that's really well managed, has made some acquisitions to grow, bought back a ton of shares in the last 5 years or so, and I think has generally done well. If the economy craters, will they do poorly? For sure, but I think they'll certainly survive and keep buying back shares, which I will like. PayPal, done a couple of videos about these guys. They're certainly not growing as quickly as they have in the past, but they're still growing a little bit. And more importantly, they're buying back a bunch of shares, generating a bunch of free cash flow, and that should look good in the long run. But I'll keep a close eye on this one. Owens Corning, again, in the home building space, they provide insulation, roofing materials, doors, things of that nature. So a lot of this stuff is tied to the real estate market. I do think that this government seems to want to push rates lower than they are right now. Whether that works depends to be seen. Whether their moves have a negative impact on the economy remains to be seen. I think the answer is going to be yes, and a lot of these stocks will probably be negatively impacted in the short term. But I think in the long term, I still believe in America, in American real estate, and a lot of these companies will benefit from that, especially the ones that are tied to the real estate space. Just like MGIC and NMI Holdings, these guys are in the same space. These are the guys that would provide private mortgage insurance to you if you don't put 20% down for your home purchase. So if you're getting a mortgage, you put 3% down, you have to pay PMI. Companies like MTG and NMIH will be the ones providing that insurance. And the nice thing about this insurance is that outside of times like 2008, where the real estate market crashed and there was a huge bubble, these companies make a ton of money. Their combined ratios after expenses are like 30%. And that means that there's 70% margins in this insurance. That's pretty impressive. And that's why I like these stocks, on top of the fact that they're also buying back a ton of their own shares. So let's look at the financials here and why I like some of these companies. Booking, kind of expensive, 27x multiple, did tick up a little bit in the last couple of days. Owens Corning, similar story, a 20x multiple, ticked up a little bit. Same with PayPal, maybe a 17x multiple. Again, these are GAAP ratios, so on a non-GAAP basis, the ratios may be even better depending on what adjustments they're making. Then you've got these other companies, the ones tied to real estate, maybe tied to cyclical business lines. You've got multiples that are 7 to 12x. So when you've got 7 to 12x multiples and you're generating that much earnings, that much free cash flow, and buying back shares, that means you can buy anywhere from like 6 to 12% of your business every single freaking year. And that's why I like these types of businesses. On top of that, some of these businesses may be misunderstood. You look at something like Jackson Financial trading at a 7, 8x multiple depending on the day. This business just IPO'd in 21, towards the latter part of 21. There's just not a lot of data on this business as a long-term entity. So maybe the market's just undervaluing it, giving it plenty of upside. Plus, you get the upside of additional stock repurchases, which they said they're going to do a lot of. You've got Mr. Cooper Group, which just recently started to transition more into the servicing side of the mortgage business. So you've got this servicing business that forms a pretty solid baseline that's relatively consistent. And you've got the origination business, which is very cyclical depending on where rates are. But a couple of years ago rather, this was a business that was super dependent on this originations business. Now it's a business that's not that dependent on this originations business. So you have this solid baseline in servicing, and you've got the potential upside of originations if interest rates were to drop. And yes, if interest rates stay elevated, will companies like Toll Brothers, like Owens Corning, like Builder kind of be pressured? For sure. But I think there's still businesses that are going to generate free cash flow. And if the stock price remains pressured while you wait for the next time that interest rates are low and housing booms again, they're going to buy back a bunch of shares. And that's pretty good for you as an investor. One thing to note with NMI, they just started buying back shares because they're a private mortgage insurer. They do have to meet certain ratios in order to be allowed to pay a dividend or buy back shares. MTG has been doing that for a while. NMI just started, so their share count reduction is only 8%, but even that, pretty impressive. And when you think about the share count reduction since 2019 or 2020 or 2021, wherever the starting point was, a lot of these companies, or all of these companies, have reduced their share count between 8% to 45%. And this is why I like share count reduction from the purposes of a business. You look at something like Builder, let's say they had $1 billion in net income in 2019. On an earnings per share basis, that's $4.84. Let's say they didn't grow at all by 2024. That means that their net income growth is zero. However, because they've done a good job with managing their money, they've returned capital through share repurchases. On an EPS basis, they've grown their earnings per share by 81%. That's the beauty of share buybacks. It's increasing your EPS without even having to grow that much on a basic level. And because these businesses are profitable, because these businesses are generating a bunch of free cash flow, and more importantly, are valued pretty attractively by the market, they can reduce their share count pretty substantially. And that's despite the fact that these businesses aren't like dying businesses. They're interesting businesses. They're businesses that can continue to grow. And I think they're businesses that 5 to 10 years from now, assuming the economy doesn't implode, are going to be much bigger on a top line basis than they are today. And they're going to have far fewer shares than they have today, which means that on a bottom line basis, from an EPS perspective, they're going to grow at a pretty solid clip. And the awesome thing about these businesses, despite the low PE ratios, is that they're not dying. They're still thriving businesses. In 2024, only one of them saw a reduction in revenue, and that's Builder. Every other one grew anywhere from 3.5% to 24%. One thing to know about Mr. Cooper Group, 23 actual growth was like negative 23%. Again, it comes back to the origination business. 21 and 22 origination business was amazing. It kind of shrunk in 23, which is where the reduction in revenue came in. In 24, it kind of remained steady, but their servicing business grew, which is why you see a 24% growth rate over here because of an acquisition they made. That's going to continue into 25. And then based on 25 estimates, you're seeing all of these businesses still continuing to grow outside of Owens Corning shrinking at 3.1%. And that's kind of what you want to see. You're getting a valuation that's pretty fair. You know, booking seems kind of expensive given the growth rate. That's probably adjusted based on some of the economic boycotts. However, everything else is valued pretty fairly in relation to the revenue growth, if not attractively given where the market is valued. Plus, they're buying back these shares at these attractive valuation. And what that does is it means your EPS growth is going to be pretty freaking good if that can continue for the next 5 years. Just look at the 19 actuals versus the 24 actuals for these businesses. When you combine their top line growth plus the reduction in shares, that leads to an increase in EPS. Cooper, $3.80 in 2019, $10.37 in 2024. Tripled their EPS. Crox, $1.61, $13.17 in 24. Quintupled their EPS. Jackson Financial just IPO'd in 22, so these are 22 actuals to 24, certainly growing. Toll Brothers, $4 to $15. What's that? Almost 4x. Booking, $102 to $187. Builder, $2 to $11. PayPal, $3 to $4.65. Owens Corning, $4.54 to $15. And so on and so forth. Growth, growth, growth. That's what you're buying here. That's what I'm buying here. I'm buying the idea that, hey, these companies aren't going to grow through the roof. The top line is not going to be up by 20%. Some years it might shrink. Some years it might shrink a lot because some of these businesses are cyclical. But during those periods of time, when the stock is up, when the stock is down, these companies are going to do what I want them to do, which is buy back shares, which is do shareholder returns via the most tax efficient way possible. And through that, they're going to grow their bottom line on an EPS basis by quite a bit, especially if they're reducing their share counts anywhere from 15 to 45%. So if 5 years from now, I'm looking at these portfolios and these share counts are 20 to 30% lower, and the company is only 2% higher on revenue growth than they were in 25, would I be happy about that? I wouldn't be super unhappy, especially if they improve their margins. And the reality is they'll probably grow a little bit. When you look at Cooper, I think this is a business that can grow pretty significantly in the next 5 to 10 years. And if interest rates drop for any reason within that period, then it could be off to the races. It could be a real compounder that we're looking at here. Crocs, again, they make silly shoes. It really depends on what they do with Hey Dude and how they handle that, but the stock buyback is definitely the right way to go about it. You've got Jackson Financial, a really solid business, good margins. Certainly not a lot of data, but one that I'm going to be following pretty closely. You've got Toll Brothers, Builder, Owens Corning, and these two private mortgage companies that are certainly tied to the housing market. That's really going to be the driver of how those stocks do in the short to medium term. If interest rates rise, if home prices drop, that could be a very big negative for these companies, and their prices would suffer as a result. They've got Booking and PayPal, again, companies that I'll keep a close eye on. I do think Booking, a little bit expensive, but it's a company that I really like. I really wanted to own for quite some time, so I added this to portfolio because they are a stock buyback company and are reducing their share count by quite a bit. And if their valuation drops a bit more from here, I'll be a lot more interested, because a Booking investment in the 20x multiple range would be really enticing. And a lot of these other guys, are certainly trading at a multiple that I'm not super worried about, especially in the face of everything else in the market. Would I rather buy a company that's growing at like 3 to 4% that's trading at a 30x multiple just because it's consistent? Or am I okay taking the risk with a cyclical, inconsistent company like Toll Brothers or Cooper or whatever, because it's trading at a 7 to 10x multiple? I think I'd rather buy the latter right now. I certainly am buying some of the other companies in my compounders portfolio as well, but I do like the risk reward profile of these companies. And I think long term, most of them will be very successful in growing their EPS, even if their top line only grows at a couple of percent a year. That's the investment thesis here. Let me know what you think down below. Leave a comment, like, subscribe. And as always, guys, not investment advice. Do your own due diligence. I am just a guy on the internet. If you're here all through the video and watched it all, thanks for watching. Thanks for sticking around. Bye.